In this video, I'm going over my top 7 stocks for the month of February 2022. I've researched hundreds of different companies, and this is my list of stocks I think should be on your watch list. I encourage you to watch until the end to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow. Let's get started. So the first stock we are talking about today is Bank of America, stock ticker BAC. Bank of America is an American multinational investment bank and one of the world's leading financial institutions. So right now, one share of Bank of America is trading at $45.87 with a 52-week low of $29.57 and a 52-week high of $50.08. If we take a look at their one-year price chart, we can see that 1 year ago, they were trading at around $30 a share. We saw a big jump in price all the way up until June, where it sort of remained at that price for a few months. And then since September, the price has really jumped up. They have a market cap of $370.53 billion, a PE ratio of 12.85, earnings per share of $3.57, and a current dividend yield of 1.85%. Yahoo Finance is rating them as undervalued. If we take a look at the valuation measures, we can see that the 5-year expected PEG ratio is 0.99, meaning we are expecting a ton of growth, and the price to book ratio is 1.51, meaning it could be undervalued. Looking at the profitability, we see that they have a profit margin of 34.13%, and they have a decent return on equity of 11.78%. In the last 12 months, they've done revenues of $93.71 billion. And looking at their balance sheet, we see that they have total cash of $888.51 billion. It's always interesting to see what analysts have to say. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are rating Bank of America as a 2.4, meaning it is between a buy and a hold. The average analyst price target is currently at $51.32, which is about 10% higher than the current price of $45.87. Now, Bank of America has already proven its durability for the past decade, increasing in value by around 700% and comfortably recovering to pre-recession numbers. Its status as one of the top 10 largest financial institutions in the world by total assets is just another testament to Bank of America's durability. Now, the company's redemption arc since 2010 has been largely overseen by CEO Brian Moynihan, who has emphasized his desire to continue leading the company. Given that Bank of America managed to climb its way out of its recession hole, I think it's safe to say that the CEO knows what he's doing, and we can hope for similar positive results in the future. Now, besides durability and longevity, we should also be looking for reasons as to why Bank of America stock will shoot up in the coming year. One major upcoming factor that makes me bullish about the company is rising interest rates. To manage inflation, the Federal Reserve has announced that it plans on raising interest rates in 2022, and we can absolutely expect financial institutions like Bank of America to profit from that. We also cannot ignore the fact that higher inflation will inevitably lead to higher prices for consumer items, which could mean that consumers need to borrow more money from banks. This is yet another bullish sign for Bank of America that we should be looking forward to in 2022. Of course, interest rates that are too high benefit nobody, but at the moment, as we take a look at mortgage rates, for example, we can clearly see that interest rates are at historical lows. In other words, it's probably the right time for rates to hike back up, and we shouldn't be too worried about interest rates reaching a dangerous peak anytime soon. Now, going back to Bank of America's recent success, the bank just announced its Q4 2021 earnings, quoting a record year with a net income of $32 billion on revenue of $89.1 billion, and citing increases in deposits, loans, and leases throughout the year, with the values nearly returning to pre-pandemic levels. In other words, people are more comfortable spending money again, and Bank of America is directly profiting from the spending hype. Since we have plenty of reasons to believe that Bank of America will continue the success it's experienced so far and will find many profitable opportunities this year, I don't see why it would hurt to at least keep BAC on your watch list for the time being. So the second stock we are talking about today is Meta Platforms, stock ticker FB. Meta is an American multinational tech conglomerate formerly known as Facebook. So right now, one share of Meta is trading at $301.71 with a 52-week low of $253.50 and a 52-week high of $384.33. So taking a look at the one-year price chart, you can see that 1 year ago, Meta was trading at under $275 per share. They steadily rose to close to $400 a share, but then saw a pretty big drastic correction back in September of last year. Since then, it's been slowly hovering at around $325 to $350 a share. But of course, with the recent interest rate hikes, we've seen a lot of tech stocks drop, and Facebook is no exception. They're a gigantic company with a market cap of $839.28 billion. They have a P ratio of 21.59 and earnings per share of $13.97. Yahoo Finance is also rating Meta as undervalued. I do think that Meta could continue dropping for the next few months, but the company is still undervalued. I think it's always a good time to buy more shares, so I'll definitely be dollar cost averaging this company. Now, if we take a look at the valuation measures, we can can see that they have a 5-year PEG ratio of 0.83, and the current price to book ratio is 6.15. They're a really profitable company with a profit margin of 35.88%, and they also have a really great return equity of 32.1%. Their balance sheet shows total cash of $58.08 billion, and they have a very strong current ratio of 4.23, which basically means that we have 4.23 times the current assets as current liabilities. Analysts love Meta, and they are rating it as a 1.9, meaning it is a buy, and the average analyst price target is $400.52, which is about 30% higher than the current price of $301.71. So like I said before, Meta used to be Facebook, and founder and CEO Mark Zuckerberg made it clear that Facebook changed its name to Meta to symbolize its commitment to the development of the metaverse. And we can see this commitment shine far beyond the name change alone. Although it's been a few months since the name change, Meta has already demonstrated its investment into the future of the metaverse with its ownership of Oculus and Horizon VR technology. Recently, Mark Zuckerberg even announced that Meta is currently developing the world's fastest AI supercomputer. And although the success of this development is still in question, the fact that he made such a momentous announcement in the first place shouldn't just be for publicity. It wouldn't be unreasonable for investors to expect some new technologies arising in the future for Meta platforms. And while we can focus on the futuristic stuff Meta's been working on for much longer, let's not forget that Meta was once Facebook, one of the largest tech and social media conglomerates in the world. They still own Facebook, WhatsApp, and Instagram. And despite all of its recent metaverse developments, Meta is still very much a social media company. Plus, I like to think that Meta's massive consumer base generates the company the appropriate revenues, resources, and influence it needs to advance the ambitious projects it's been working on, especially in regards to the metaverse. And if we look at the company's most recent earnings, we can see that the company generated very favorable figures, with a net income of $9.19 billion on a revenue of $29.01 billion, which is a 17% and 35% year-over-year growth in those two figures respectively. Investors are looking forward to hopefully seeing more profits on paper once again on February 2nd, so absolutely be on the lookout for that. There are definitely analysts who believe that Meta will exceed expectations, but we'll only know when we see the results for ourselves. Anyways, I really do have faith in Meta as a long-term hold simply because the company is already so durable and because it's obviously looking to the future of business and tech. Like I said earlier, I will be dollar cost averaging this company. If you want to increase your chances of making money with investing, it matters what platform you trade on. That's why I'm super excited to announce that I'm partnering up with Moomoo long-term this year. They are a stock trading platform that I personally use and I'm very happy to recommend to my audience. Now, one big reason why Moomoo is going to be taking over the space is because of all the free high-level tools that they include. For example, advanced charting, free level 2 data, AI tools, and more. Every single free tool that they have, which most other stock platforms lack, helps you make better informed decisions about what stocks to invest in and when to buy them. I also really like their user interface as it helps me keep track of the stocks I'm invested in and the news surrounding them. They're also a zero commission platform that makes no money from payment for order flow, meaning you're always getting the best buy and sell prices available compared to many other brokerages out there. Right now, they are having one of the best promotions out there of any brokerage, allowing you to get up to 5 free stocks worth up to $3,500 each when you open up an account and make deposit. I've done my due diligence and really encourage you guys to start taking advantage of their awesome trading platform that will help you make more money while also getting those free stocks. So I'm putting a link down below, and it's super easy to create an account and make your first deposit today. Come join this incredible community of investors. See you there. And now back to the video. All right, next on our list is Bristol Myers Squibb, stock ticker BMY. This is an American pharmaceutical company, and it's also one of the largest pharmaceutical companies in the world. So right now, one share of BMY is trading at $64.91 with a 52-week low of $53.22 and a 52-week high of $69.75. About 1 year ago, we see that their price was around $62 a share. It gradually increased all the way up to the high 60s back in August. Saw a big drop in August and September, followed by another dip at the end of November. But since then, we have seen a pretty significant rise in the price. They have a market cap of $144.07 billion, no PE ratio since they are not profitable, an earnings per share of negative $2.42, and they pay a mild dividend of 3.47%. We have a 5-year expected PEG ratio of 6.59, a price to book ratio of 3.71, a profit margin that's currently negative at negative 11.89%, return equity of negative 12.31%, and looking at the balance sheet, we see that they have total cash of $15.82 billion with a decent current ratio of 1.47. Analysts are currently rating BMY as a 2.1, meaning it is a buy, and the average analyst price target is $72.22, which is just over 10% higher than the current price of $64.91. So despite some volatility that should be expected from most pharmaceutical stocks, BMY is up over 2% in the past month, and I hope that it can continue this growth over the next few years. The company is already one of the largest pharmaceutical institutions in the world because it owns 3 particular drugs that have already massively contributed to its success. First of all, Bristol Myers Squibb is responsible for developing the oncological drugs Opdivo as well as Revlimid. Both of these medications have long been lauded as effective treatments for cancers. They're also known for developing its anticoagulant drug known as Eliquis. Unfortunately, the patents for these drugs will be expiring soon, but what makes BMY a great company is the fact that it has a portfolio of products waiting to provide even more revenue for the company in place of these 3 drugs. So to start off, the company is currently developing a blood treatment drug known as Reblozyl, which the company predicts can generate more than $4 billion in annual sales by 2029. We also have mavacamten, a potential treatment for a heart condition called symptomatic obstructive hypertrophic cardiomyopathy. This drug could earn early regulatory approval this year, and if it does, the company expects it to once again generate annual sales of at least $4 billion in the not too distant future. And finally, the company has developed a new drug that I'm not going to say because I can't pronounce it, but it does start with a D. And yeah, this is a potential treatment for psoriasis that may also earn the regulatory green light in the US as well as in Europe sometime this year. And it's great because their drug has been proven to be more effective than one of the biggest psoriasis treatments in the market right now, which should render the drug as a competitive force against big treatments for the disease. Another thing I really like is that they are known for consolidating strategic partnerships with other pharmaceutical or medical companies. For example, recently the company partnered with Century Therapeutics to license CAR-T cancer programs. In this partnership, Bristol invested $100 million upfront plus another $50 million into a cancer treating program, showing the company's abundance of resources and ability to reinvest those resources into other money-making opportunities. And yeah, as investors, we will be able to see just how large this pool of wealth is for the company as they are announcing their earnings on February 4th before market open. Be on the lookout for that, and I highly suggest keeping this stock on your watch list for at least the year as you monitor the regulatory updates for the company's newest drugs. Overall, a great company that I will be keeping on my watch list. All right, next up is Charles Schwab, stock ticker SCHW. Charles Schwab is an American financial company offering banking, consulting, and wealth management services. Right now, one share of their stock is trading at $88.91 with a 52-week low of $50.77 and a 52-week high of $95.62. So looking at the price chart, we can see that it's actually gone up pretty steadily over the last year, and we really have not seen any big corrections. They have a market cap of $168.093 billion, a P ratio of 31.42, earnings per share of $2.83, and they pay a small dividend of 0.8%. If we look at their valuation measures, we can see that they have a 5-year PEG ratio of 1.13, and they currently have a price to book ratio of 3.58. They have great profitability with a profit margin of 31.61%, and they have return equity of 10.32%. Looking at their balance sheet, we see that they have total cash of $77.52 billion. Analysts do like the stock. They are rating it as a 2.1, meaning it is a buy, and the average analyst price target is $104.61, which is over 20% higher than the current price of $88.91. So Charles Schwab is one of the largest brokerage firms in the country, and it's easy to see why. To start off, their investment services still rival the greatest competitors in the industry as well as the worthiest newcomers. The institution as an investment broker really is an all-in-one investment service. They experienced wonderful growth over the past year as it grew in value by nearly 67%. The reason for this growth was the company's earnings season, with the company posting a record $1.58 billion in net income on a $4.71 billion revenue, 39.21% and 12.74% year-over-year increases respectively. Charles Schwab's acquisition of TD Ameritrade back in 2020 certainly helped the company's future outlook and growth, as TD Ameritrade itself is an acclaimed investment brokerage platform. In fact, Charles Schwab opened millions of new brokerage accounts through both TD Ameritrade as well as the company's own platform during 2021. This is a testament to the company's durability, and we as investors can definitely expect Charles Schwab to stay in the throne as one of the largest brokerage firms in the country trajectory for a long time. Considering the fact that 2022, like I said earlier, is projected to be an interest high year, we should also see some positive benefits for this stock. If you're looking for a place to invest your money long term, I do think that SCHW could be a good pick for you. So next on our list is Lemonade, stock ticker LMND. Lemonade is an American insurance company that offers all sorts of insurance types and services, from renters and homeowners insurance to car and pet insurance. Right now, one share of Lemonade is trading at $28.76 with a 52-week low of $25.83 and a 52-week high of $171.56. So obviously, looking at the one-year price chart, we can see that the price of Lemonade has been dropping significantly. 1 year ago, they were almost at $200 a share, saw a huge price correction followed by a price increase back in May, and since then, it's just been on a steady decline. So yeah, this definitely is a riskier stock, but as you'll see, they are doing a lot of cool stuff, and that's why I really like this company. They have a market cap of $1.773 billion. They're not yet profitable, so they don't have a PE ratio, with an earnings per share of negative $3.41. Very not profitable right now, with a profit margin of negative 189.9%, a return on equity of negative 25.34%. And looking at their balance sheet, we see that they have total cash of $426.9 million and a great current ratio of 1.96. Analysts are a little bit iffy about this company. They are rating it as a 3.2, meaning it is a hold, but the average analyst price target is $56.33, which is almost twice the current price of $28.76. Lemonade has returned to its IPO price, which is not the greatest news to hear because, as you saw, they reached over $180 at one point. The reason for this plunge? Well, many investors expressed concerns about the company's increasing losses, declining growth, and its acquisition of a struggling auto insurer called Metromile back in November last year. However, it might be too soon to completely close the door on Lemonade, as the company definitely still has room to grow and may now be selling at a very, very big discount. To start off, Lemonade is a business that mainly appeals to young people and first-time insurance buyers, a trend that was identified years ago during the company's ascent. Market trends like these don't go away after a year or two, and I suspect that Lemonade's insurance brand will continue to appeal to more and more young people. Another huge factor to consider is that Lemonade still has the means and intents of expanding its portfolio of businesses and products, indicating that the company still has a pool of resources to work from, and the company still has more plans for its future. First, let's take a look at what the company already offers. They're mainly known for selling renters insurance at a cheaper rate than other insurance companies, but the insurance company also offers homeowners insurance and pet insurance. With its controversial acquisition of Metromile, bullish investors are keen on seeing how Lemonade makes use of Metromile's resources to expand upon its newest product, which is auto insurance. Metromile's tech and database has already collected information on millions of road trips and billions of miles traveled, meaning that Lemonade has access to all sorts of auto information that may benefit services, especially when they are fulfilling claims. Bullish investors are also keen to point out that Lemonade is a fully disruptive company in the insurance industry, and that's for two specific reasons. The first reason is that the company is AI-based. Its decisions are carried out automatically through artificial intelligence, making its services fast and efficient. They can literally make decisions in minutes, and their claims process is also much more simple. The second reason that Lemonade is disruptive is because the company's business model is different than other traditional insurance companies. While other companies collect the money left over after fulfilling claims, Lemonade collects premiums up front, and leftover money after fulfilling claims is donated to charity. While this is a clearly more speculative company that has yet to prove its competitive durability within its own industry, I see a great risk-reward ratio for LMND. I do have faith in its innovative technologies and its disruptive models, and if they can fully take off with its transition into auto insurance, I do believe that they will almost certainly reap profits for investors. Of course, like I said, very risky investment right now, but definitely a stock to keep an eye out on. All right, the next stock we are talking about is Procter Gamble, stock ticker PG. Procter Gamble is an American multinational consumer goods corporation that specializes in personal health and hygiene products. Right now, one share of the company is trading at $160.50 with a 52-week low of $121.54 and a 52-week high of $165.35. Their one-year price chart shows really consistent growth throughout the last year, with a pretty big spike back in December. They have a market cap of $384.73 billion, a P/E ratio of 28.39, and they have a mild dividend of 2.19%. Their 5-year expected PEG ratio is 5.81, and they have a price to book ratio of 8.66, both of which mean that this company could be overvalued right now. They have a They have a profit margin of 18.52% and a really great return on equity of 31.09%. They have total cash of $11.54 billion, and the current ratio is on the low side at 0.67. Right now, analysts are rating them as a 2.4, meaning it is between a buy and a hold, and the average analyst price target is $166.26, which is just about 4% higher than the current price of $160.50. Straying away from a relatively brand new company like Lemonade, we now focus on Procter Gamble, which is one of the oldest companies in the world. And while we might not expect groundbreaking innovation from a company that focuses mainly on personal health and hygiene products, it should surprise investors that a company like Procter Gamble has not only stood the test of time, but has also weathered the storm of rough economic conditions along the way too. First of all, it's really surprising and intriguing to see a company as old and as normal as Procter Gamble manage to fully catch up with the growth of the S&P 500 during its last 5-year bull run. More specifically, P&G experienced a steady but significant 82% growth in the past 5 years, and they've faced and are currently facing significant economic potholes, such as climbing inflation rates that are increasing material costs. Nonetheless, the company has proven its durability by adjusting to these conditions, whether it be through hiking up product prices, cutting costs, or saving money in other sectors of the company's business, as well as implementing premium, high-demand products within their catalog related to fabric care or skincare. As a result, the company is beating sales targets. They report a 6% increase in organic sales, experiencing success from the fabric and home care sectors, as well as the healthcare niche of the business. This infographic can be found in the company's most recent earnings report, where P&G also reported an increased free cash flow productivity of 95%. What exactly does this mean? Well, free cash flow productivity basically means how readily can Procter & Gamble turn its earnings into free cash that can then be paid to creditors or investors like us who've invested our money into the company. This is perfect because Procter & Gamble pays out dividends to its investors, with the company recently declaring a quarterly dividend of 86.98 cents per share. So yeah, another great reason to own shares of PG with their dividend payout. Overall, I do really think that they are a durable and undeniably solid company that offers large catalogs of products that people will likely always need. They're not going away anytime soon, and with its remarkable growth throughout the last 5 years, I'm definitely going to be keeping an eye out for this one in the long term. All right, the next stock we are talking about is Kinder Morgan, stock ticker KMI. Kinder Morgan is an American energy infrastructure company specializing in owning and managing oil and gas pipelines and terminals. So right now, one share of the company is trading at $17.20 with a 52-week low of $13.75 and a 52-week high of $19.29. The 1-year price chart shows a good amount of volatility, and we can see that 1 year ago they were trading at just about $14. From February to June, they shot up to $19 a share, dropped back down to just under $16, and since then we have seen some volatility. They have a market cap of $39 billion, a P/E ratio of 21.86, earnings per share of 79 cents, and they have a very high dividend yield of 6.16%. They have a 5-year expected PEG ratio of 0.42 and a price to book ratio of 1.29, both of which mean that this could be very undervalued. They have a profit margin of 10.74% and a rather low return on equity of 5.74%. Their balance sheet shows total cash of about $1.14 billion, and they also have a low current ratio of 0.66, which is definitely something I'd like to see them do better on. Right now, analysts are rating them as a 2.9, meaning it is a hold, and the average analyst price target is $19.02, which is about 10% higher than the current price of $17.20. So speaking of dividends, one of the most reliable stocks you could possibly ever own is KMI. For a bit of context, Kinder Morgan operates the largest natural gas pipeline network in the US, and it has a business model that is unique from other energy companies, but is also very predictable. Right? Kinder Morgan makes money through long-term contracts that make its projections and figures easy to predict. In fact, when the pandemic hit in spring of 2020, Kinder Morgan updated its complete financial estimates for the rest of the fiscal year. And once the fiscal year ended, the company's initial April guidance ended up being over 99% accurate, which is just insane considering the fact that they were operating in a highly unpredictable time for the economy. This fact is a testament to the true durability and predictability for the company's business. And while it may be a boring company for some investors, I find it extremely appealing that a company can accurately explain to investors exactly what to expect from the company's business and profits. In fact, Kinder Morgan has already laid out its full year 2022 guidance for investors to look at. And yeah, the company expects a higher adjusted EBITDA, higher earnings per share, higher net income, and higher full year dividend per share compared to last year. So yeah, it's really great that they are telling investors that they expect to perform even better this year than last year. Even though they're already so stable and durable, I do like that they are still taking strides to expand their business. For example, they've made some crucial acquisitions in the past year or so that really had a positive implication for the company's future outlook. For example, they acquired Stagecoach Gas Services back in July of 2021, which analysts project will serve a critical role in expanding on Kinder Morgan's Northeast sector by adding more miles of pipeline and implementing more energy storage facilities. Kinder Morgan also acquired Kinetrex Energy back in August of 2021 with the joint goal of harnessing methane emissions from landfills and turning it into useful energy. So in other words, the company has struck a delicate balance between two worlds. In one world, they're super stable and forecastable, and in the other world, Kinder Morgan is still expanding its business and network further throughout the continent. They've really made it clear that they seek to consolidate shareholder value not through an increase in stock value, but rather through dividend payments. Fortunately, the company very recently announced a 27-cent per share dividend, a rate that the company has consolidated through solid cash flows and healthy balance sheets. Because of all these reasons, I think that KMI is definitely worth checking out. Anyways, those are my top 7 stocks for the month of February 2022. If you guys want some free stocks, definitely check out Moomoo and take advantage of their limited time offer of up to 5 free stocks. Now, I really want you guys to do your own due diligence before investing in any company. I'm not a financial advisor. This should not be considered financial advice. Rather, it's just an analysis of 7 different companies that I currently like. Monetary policy is becoming tighter to tackle high inflation, and this is really going to affect sectors like high growth tech. However, more value-oriented sectors like industrial, energy, and banking should hopefully fare better in the current climate. So yeah, definitely an interesting time to invest, but you really can't go wrong with just dollar cost averaging and buying for the long term. It's very, very likely that some of these companies could go down in the short term. Anyways, I hope you guys enjoyed the video. If you guys did, make sure to hit that like button and also subscribe for more content just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.